Hi, it's Jeff Nunley from Peak Mortgage. Hey, here at Peak Mortgage, we like to take each month and either give you a lending strategy or talk a little bit about different programs that you might be able to use that are beneficial in the marketplace to help you buy a home. This month, we're focusing on the Rural Housing Program, or USDA. Now, USDA is a 100% program. It's run by the U.S. Department of Agriculture. It requires no money down. It gives you the opportunity to buy houses in underserved rural areas, and that's the purpose of the program. The program is designed specifically to allow people who might not otherwise have the opportunity to buy, people in lower income ranges, the opportunity to get a house without providing a down payment in an area where there's maybe less of a demand for housing on the whole. So there's a couple of different types of USDA programs. Today we're going to be focusing on the guaranteed, which is the one that your lender does, the one that your bank does, and that is guaranteed by the U.S. Department of Agriculture. And so your lender does the loan, and then the U.S. Department of Agriculture, in the event you are unable to make your payments, they guarantee a percentage of that loan back to the lender. You pay a fee for that, but it allows the lender then certainty that they can lend the money to you 100% of the financing. Very similar to the way a VA loan works, only through the Department of Agriculture. Now, there's a second program too that you won't talk to your lender about. You have to go directly to USDA, and that's why they call it the USDA Direct Loan Program. Now, that program, you go to USDA, it's designed for people on the lower income tier, not moderate income tier, which is what the guaranteed is designed for. The program is much more restrictive, but it is the program that many people think of when they start talking about the USDA program. So it's important to understand these two different options because there's vast differences. The other program, the USDA program, the direct program, is for low-income borrowers. You have to wait a long period of time in most cases, even if you do qualify for the housing. And in many cases, if you do start doing better, they're going to raise your monthly payment. They also might make it difficult for you to do improvements to the home, or at least you have to ask for prior authorization in many cases to make certain home improvements that on the guaranteed program where you simply own the house and the USDA guarantees the financing for the lender, you don't have those restrictions. So that's the program we focus on here. So the guaranteed program in our area, a family of four can make about $76,000 a year. Now, if they do make more than that, they would not qualify for the program. The program is designed, as we said, for moderate income, but that's a pretty substantial family income for our Lane County area. Now, this will vary depending on where you're at, even within your own state. So there's some great resources, the ability to go in and check the tool, and I'm going to add that link at the bottom of this post as you go to our WordPress page, all about mortgages here. You'll see that link, so just click on that, throw in the address of a home you're looking for, it'll pull up the map and it'll tell you whether or not the home's in there. It'll also tell you based on your area what the income requirements will be. So some great resources there. Now, the good news about this program is that it's a zero down program. It's also a great program because the mortgage insurance premium, or monthly guarantee fee, is also substantially lower than FHA. FHA has a 0.85% guarantee with the minimum down payment, 0.85% mortgage insurance, and this one has a factor of 0.5, so you get a substantial savings. Right now, the fee for this loan is only 2%. So if you finance $100,000, they're going to add $2,000 on top of that, make it $102,000, 102%. Now, that is changing. In a couple of months, we're going to be going to 102.75. So the loan program is going to be getting more expensive, but the monthly premium, the one that's really going to make the difference on the monthly payment, is going to stay the same, and that's important. So another feature of this product, or maybe not so much a feature as something to be aware of, is that unlike FHA, where FHA lets you play with your debt-to-income ratios quite a bit, on this program we need stability of income, we need and we need predictability of income, and we will not let you over borrow. The debt-to-income ratios on this are pretty well set. They stay very low. There are some things that we're able to do with an automated underwriting system, and there are some exceptions to be made if you have great credit. But suffice it to say, you're probably not going to go any higher than about 43% of your gross monthly income on this program for all of your debts, even in an exception basis. Okay. Now, the good news on this program too is that you can get the program itself qualifies down to about a 580 credit score. So you don't have to have perfect credit, but the better the credit, the more exceptions you're going to get on income. And you still have to meet certain criteria. We don't want to see late payments in the last 12 months. We don't want to see open collection accounts. So these are things to be aware of, that you shouldn't have. A couple of small medical collections may be okay, but you certainly wouldn't want to have any large collection accounts open. You certainly can't have any judgments like any other loan program, and you certainly would want to have eliminate a majority of those late payments. Doesn't mean you're going to have a great credit score if you do those things. So the program itself writes down to 580. We actually here at Peak, we can go down to a 620, which is more common, maybe even 640. So this will vary from lender to lender, and it's important you know that so that you have the opportunity to shop a little bit if you happen to have those lower credit scores. So another unique feature of the program is that there's no restriction on what the seller can pay. So what I mean by that is in terms of the closing costs. So in many cases, people would do 100% financing, and then in most cases, they're going to ask the seller to pick up the closing costs. Now, there's no restriction on what that is. So on lower loan amounts, that can be very important, because if you're buying a $120,000 house, 1% of the loan amount is only $1,200, and your closing costs may end up being still $3,000 to $4,000. Under certain loan programs, that would not work. If you're putting a minimal amount down, you would be restricted as to how much your seller can pay. With USDA, there is no specific restriction, so your seller can pay all your closing costs. You can literally get in with no money out of pocket. Even if you're putting up earnest money, it's refundable. If you pay for your appraisal, you can get that back. There's lots of opportunity in USDA. Now, one other thing to understand about USDA is this is really a rural community development program. While we'd like to believe that farm home means farm, it really doesn't. So, there are certain things you need to look out for on a home. First of all, if it's not a brand new placement, you're going to have to go with the stick-built home. No manufactured homes on resale. The second thing is having to do with large outbuildings. Now, outbuildings, honestly, I think that the USDA is a little more lenient than some lenders lead us to believe. But what I can tell you is if you have a large outbuilding that's greater than what you'd use for car storage, and it looks like it's being used for an agricultural purpose, like a large barn or a pole barn or a silo, any sort of large outbuilding that has an agricultural use, this is not the right program for you. So if you're looking for a down payment program, 5% conventional, VA if you're a veteran, or FHA at 3.5% down. If you have a very large shop that looks like it could be used for commercial purposes, same thing goes. We want things that are typically for car storage, basic household equipment storage are fine, but don't get overboard, and talk with your realtor and your lender about whether or not that outbuilding you might be getting is going to qualify or disqualify the property for USDA. The good news is, and this is extremely important, especially to you realtors out there who may not know this, USDA made some changes earlier this year where now if a home is in a floodplain, so if you can get flood insurance on it, have to get flood insurance on it, but if it's in a flood zone, it is now eligible for USDA without specific restriction. That's important because areas around here like Junction City are half in the floodplain, which means previously half of Junction City, which the city proper qualifies for USDA financing, half of the city didn't qualify because it was in a flood zone. And now we've eliminated that restriction. Now you still have to be able to qualify with flood insurance, which is not easy to do because flood insurance is really expensive. But you do have the opportunity at least to look at homes that you previously didn't look at. So I hope this has given you a good solid primer on one of the best zero down programs out there. One of my favorites, and gives you the additional information. We're going to feed you a little additional information about the process of getting the loan in a different video here coming up. So I appreciate your time, and we'll talk to you soon. Thank you.